Okay, welcome to today's webinar. We're excited to have you guys joining us, the state of the automotive industry. I'm Darrin Barney. I'm the owner and CEO of Elite, here with my good friend Jim Murphy. He's our pro service facilitator and an all-around awesome guy. We did one of these in the spring of this year, and we had such great demand for it, and people were asking about it, so we decided to do it this fall too. And we asked Jim, and he said he would, love to do it. So, Jim, why don't you tell everybody a little bit about you? I know most people do know you, but why don't you do a little bit of an introduction?
Oh, yikes, I'm being put on the spot. I don't have any notes for that. So Jim Murphy, Sherry and I live in Flagstaff and Phoenix, Arizona. And my background is automotive dealership background, automotive manufacturing background, small business background. And I've been coaching automotive repair shops now for 25 years. Love every minute of it, and made a lot of millionaires, which has been really fun.
That's
And
good.
yeah, it's super fun. And I do this for fun more
Right.
than anything else. So I love doing it. So I do it for fun, much to the dismay of Sherry sometimes, but I do it for fun. So
Right. Well, thanks, Jim. We're glad that you're here. I know that you got a busy schedule, so appreciate you taking time out of the day to do all of this and kind of give us your insights into the things that are going on in our economy and especially automotive industry.
yeah,
Did these some of this at our pro service meeting last 2 weeks ago, and it was awesome. I always love hearing, uh, you know, the things that you gather and the things you put together. So it's very insightful.
yeah, just so that others know as well. I mean, I've been doing this year after year after year for pretty much the entire time I've been um, working with automotive repair shop owners. And I it's a hobby for me. The economy and looking at the industry is just fascinating to me. I invest in small businesses. I invest in large businesses. I like watching trending. I like trading in the stock market. So being able to share this kind of information on a consistent basis is, I think, helpful for the guys. I think it gives them some insights as to what I potentially see on the horizon. Again, I don't have a crystal ball. I'm not always right, but if I can get 7 out of 10 right, I feel like I'm doing pretty well. So it's pretty helpful, I think, for everybody to at least move out of their their limited focus of what's happening in the world, and kind of bring their minds out to 30,000 foot level and get and think about that and look at trends and say, how's that really going to affect my business coming up, and
Yeah.
how can I make adjustments accordingly? And I think it's helpful to have some of those kind of insights on a consistent basis. So that's what I do for the guys in pro service pretty regularly.
Well, that's awesome, Jim. And look forward to hearing that. So thank you everybody else in the audience for joining us too. We're glad that you're here. The way that this will work is Jim has a great presentation built for you guys. He's going to go through and talk about his insights and a lot of things he's learned there. And then we'll stop about halfway through and answer some questions. And then we'll also stop at the end and answer questions too. So feel free to put them into your chat right there. And any questions or anything that you have, any comments you want to make, feel free to put them in the chat and we'll address them as they come up. So cool. Well, Jim, are you ready?
I am. Let's go.
All right. Okay.
Okay, so the first area that I want to address is I always try to look at things on a more of a macro level. So really, how's the balance of 2024 going to look and 25 looking? And I'm going to stay out of some of the political influence that we may experience coming up in the next couple of weeks, but slow U.S. expansion, I think, is likely to continue. While economic surprises have been positive and negative lately, leading indicators and central bank policies point to a slow expansion gaining traction the balance of this year, and I think going into 2025 as well. So U.S. GDP grew a revised 3% in the second quarter of this year and 3% in the third quarter. We just saw an adjustment to that today. It just came out that it was about 2.8%. So the Fed stands ready to support growth as fiscal boost to from the pandemic really fades and unemployment rises. Quantitative measures have shown easier financial conditions since the Fed stopped raising rates back last summer in 23. So financial conditions ease considerably further when the Fed pivoted late last fall when Fed Chair Powell signaled the policy would be to cut interest rates rather than raising them more in that December meeting last year. So in addition to telegraphing rate cuts for 2024, the Fed's dialed back the pace of quantitative tightening, and which has also helped ease financial conditions. So better liquidity is evident in improved money growth after the shrinkage that occurred while the Fed was raising rates. So if you look at this particular chart, you can see that the M2 money supply increased in recent months. So, as you look at the overall, you can see the downward trend coming out of the left where we were really tightening and fighting inflation furiously. So the Fed was tightening up liquidity within the economy. And now we kind of flattened out through the end of 23 and then started actually adding liquidity again this year, because the Fed is working slowly to see if they can do this soft landing and not run into a deeper cycle of a recession. We're going to talk about business cycles here in a moment. So while monetary policy has turned easier, the U.S. economy is still coming off inflationary highs and we're fueled by all that financial stimulus. So most U.S. consumers are feeling the pressure from prices that have outstripped income gains over the past 4 years. So this pressure is not very evenly distributed. Low-income households are showing the most need to economize because of the rising prices, and high interest income and rising asset prices have kept the highest income brackets spending, especially if you look at leisure and travel activities. When you look at, there's some evidence that stress is moving up the income scale. The thing that I'm seeing right now is that overall, the Atlanta Fed GDP estimate for Q2 consumer spending has steadily dropped from 4% late April to 1.1% in July, and that trending has really kind of continued. So slowing consumer spending growth reflects softening job and wage growth. You saw some more announcements today that that Visa is going to be laying off another 1,400. So you're starting to see a weakening demand environment for hiring, which has pushed unemployment rate up from 3.4% of a low to 4.3% in July. The latest figure coming out is at 4.1%. We'll see the JOLTS report came out yesterday and was indicating that there still looks like that we may be seeing some additional unemployment. We'll know on Friday's numbers. So basically, wages are finally moving up faster than prices, and so that's pressuring profit margins and causing businesses to slow hiring. And then rising household net worth continues to be a tailwind for higher income consumer spending, but rising credit card delinquencies really is suggesting low income spending could slow even further. So with rising delinquencies, job losses will really be important to watch. So again, looking at what will happen for that that number on Friday is going to be pretty important.
Okay.
So looking at next slide, consumer sentiment for the University of Michigan sentiment index, it plunged to a 7-month low in early June. It had one of the biggest month declines since August of 21. It was dropping 98.7 from 105.6 in August, as Americans were growing more concerned about looking at inflated prices. I think the upcoming presidential election could have an influence on sentiment in the next couple of weeks. Even though inflation has slowed in recent months, consumers anticipate prices will climb at an annualized pace of 3.1% over the next 5 to 10 years. What's really interesting that I think all of us really need to think about, if consumers are anticipating an increase of about 3.1% on an annualized basis over the next 5 to 10 years, how do we need to react looking at this, considering how our business practices are being potentially influenced? So, I think that the other thing that probably will continue to keep pressure on is that the government's continuing to borrow money, and we'll talk about that just briefly as well in a bit. But the question to all of you is that, and I can't get responses from you at the moment, but how long does it take for prices to double? If it's your 3.1% inflation rate, how long does it take for prices to double? So those of you that are really smart in the audience, you're already knowing, hey, wait a minute, the rule of 72 leads me to believe, how to get to that answer. So the answer is that it takes 23 years for prices to double if I'm going to pace at 3.1%. Okay, so think about this, everybody. If your labor rate today is at $130, in 23 years, theoretically, it should be at 260, right? So that would mean that you should be consistently raising your labor rate at the rate of $5.65 a year, or 47 cents a month. So this is why I think it's really important to pay attention to economic cycles, because of the fact that it's your internal customer, it's your service advisors that really react poorly when you don't plan accordingly, and suddenly you feel you're behind the curve and in raising your labor rates, and suddenly you bump at $7 or you bump at $10 because you really feel that you're behind in keeping up with your cost of goods sold with your technicians. So instead, I would rather advocate that let's be smart in the way that we're handling our businesses, so that if we know that our pace of inflation is going to be 3.1%, and even if the Fed's at 2.5, we still should be looking at consistently raising the labor rate over that period of time, so we don't shock our advisors and pull away their confidence in their ability to be able to sell to your consumers. Your customers probably aren't going to feel it, being on those jumps that you'll do, but I think it's better just to do it on a slow burn. So, according to the University of Michigan, one of the gauges assessments of personal finances actually dropped 12 points to 79, the lowest level since October of 23, because of concerns over wages in the labor market. Um, Despite earlier in the year the surge in non-farm payrolls. So I think the labor market resiliency is starting to fade amid fewer job openings and unemployment rising to 4.3% earlier this year, which was the highest level in more than 2 years. So there's one more anomaly in September where the employers added 254,000 and the unemployment rate dropped to 4.1%. And October readings just came out yesterday, on the consumer sentiment side. So it rose actually to 108.7, which was a pretty big jump. And so we'll see if it's an anomaly or not, because it's the largest jump that we've had since March of 2021. So we may see, in a short term, potentially, some job acceleration again. So we'll, like I said, know more on Friday. So the next thing I want to do is I want to pause a bit about consumer sentiment. So if we look at the consumer sentiment survey, it's an index, of survey of confidence levels in the United States conducted by the University of Michigan. So it's the survey is based on telephone interviews that gather information on consumer expectations about the economy. So consumer sentiment is a statistical measurement of the overall health of the economy as determined by the consumer opinion, right? So it takes into account people's feelings towards their current financial health, the health of the economy in short term, and the prospects for longer term economic growth, and widely considered a useful indicator. So at the end of the day, what's really important about this is because consumer spending accounts for 68.1% of gross domestic product in the US. So a very large portion of it. So the MCSI is regarded as one of the most important indicators, followed by really businesses, policymakers, and participants in the investment community. So when I discuss average RO changes with many of you, a lot of times what I'm hearing is that, hey, I've noticed a real slowdown in consumers, buying. I maybe have not seen slowdown in car count, but maybe I'm seeing our close ratios, deteriorating. And there are ways to actually look at those types of trends. So I'm going to back out of this for just a second and show you an interesting website. So there are surveys of consumers from the University of Michigan. So if you go to this particular website, these are the latest updates for September, and you're going to say, okay, well, let me look at the index of consumer sentiment just as a summary, right? So I can click on the PDF file and I can actually see the index of consumer sentiment. So over the last 10 years, you can look at where the trending has been, especially of late. We went through COVID. We went through a lot of the inflationary period where folks didn't feel that good about what was happening and their ability to be able to
Yeah.
buy. And so now we've started to see some rise through 2023 and 24. We saw this up and down behavior, right? And so now we're starting to see just a bit of an uptick. What's fun about consumer sentiment, charting, is that you can see where personal finances are, how people feel about their household finances. You can look at how they're feeling about their savings and retirement. You can look at how they're feeling about economic conditions, their employment picture, and then household durable goods as well. But the other one that's kind of interesting is looking at buying conditions for vehicles. So this is another area that I really try to pay attention to as I'm working with all the guys in the group, and looking at this particular cycling, right? So buying conditions for buying cars goes in cycles as well. So you can see what consumer behavior seems to be like at this point, where we had um, all these leaps and increases in vehicle pricing, and so sentiment towards buying vehicles was not that good. And then interest rates climbed, and so that put a cap on looking at buying conditions for new vehicles. And so we'll have to see again where trending is. We've had a slight uptick in trend, but still overall, when you look at overall sentiment, it's still not that good. So
Yeah.
that's a real plus for us when I look at what our plans are going to be within all of our stores. So
Well, it
it's
just
just
means that people are going to fix them rather than go and buy another one. So that's good
absolutely,
news.
yep.
Good.
So that's what those are the types of things that we're looking for, right?
Yeah.
So let's talk about looking at the cycles of business, right? So the U.S. had more pandemic stimulus than most countries, and more growth and more inflation. So as a result, inflation is still higher in the U.S. Interest rates are higher, and the economy is still more of a late phase type of a cycle. So the Fed rate cuts seem to have reassured markets that monetary policy will ride to the rescue before unemployment causes a real deep recession. So this soft landing policy that you keep hearing about is keeping optimism elevated. It's slowing inflation, and it's boosting the confidence in the Fed's ability for credibly lowering rates without causing a severe recession. So quantitative easing or negative real interest rates characterized a period where monetary policy was working to support demand and avoid deflation, while the private sector worked off its excessive leverage balance sheets. And so private sector finances are in good shape at this point, and the government sector is a source of what's likely to be increasing debt related problems. So the shift from raising rates to cutting rates as inflation comes down has triggered an upswing in GDP. You can see it's happening in a lot of the numbers that I just mentioned. So this indicator has improved for 6 straight months, consistent with leading indicators showing the economy moving further into expansion territory. So it's going to be kind of interesting when you look at some of this. So when you say some prognosticators, so when you're looking at the early stages of after a trough, after a recession, there's a lot of arguments among those that follow this type of stuff. Are we into an early expansion stage where we've already gone through the trough of a recession, or are we at a peak getting ready to minimize what's happening and then maybe seeing a dip in recession? And I think that's what the Fed is really trying to accomplish at this point, is they're teetering on the fact that I kind of in the camp where I think that we're in a late cycle, is just my personal opinion. And if the Fed is very successful, then we'll shallow out the trough as to and not see much of the way of a recession that would lead us to having unemployment rates peak or things of that nature, and then start to come out and rise again into more of an early stage of an expansion. So that's what I'm kind of hopeful that we'll tend to see. And if animal spirits after the election really start to fuel some of this, we may be able to level out this potential trough and not see any kind of significant recession. But we'll talk about some of those indicators here in a moment.
Okay.
So I believe that rate hikes have worked to slow the economy, and therefore I think I remain convinced the Fed will continue to cut rates. That's what Chairman Powell really has telegraphed. And if you look at some of the statistics that are out there now, they're going to meet in November and December, and it's highly probable that we will see another quarter point in their next meeting. So when you look at as just one of the hypothetical examples, the outcome of the 2024 elections are leading to an increase in animal spirits, as I talked about, and consumer spending really starts to ramp up as we come through the latter part of this year. It may force the Feds to look at changing their position as to whether they'll continue to trim interest rates or not. So we'll just have to see as the rest of the year unfolds. So currently, the Fed has held rates steady and notes that they see continued progress on inflation. So the committee judges that the risk to achieving employment and inflation goals really continues to move into better balance. So the markets are looking for signs the Fed will cut rates when it meets coming up here. So now with futures pricing pointing further cuts forward in November and December meetings, I think it's going to be probably a quarter percent move coming up. There's some positive inflation data in the ADP report, with wages increasing at their slowest pace in 3 years. So again, from a planning standpoint for all of you and thinking about what's happening with your employees, over the last couple of years, my advice was to continue to raise labor rates at a pretty furious rate, because of the fact that we were getting so much wage pressure with especially our technicians. So cost of sales were really forcing us to make moves. And I think that you'll start to see a little bit of a slowing pace with that. I mean, I wouldn't let your guard down because of the fact that, we have, technician shortages still out there, but overall expectation for wages and benefits and salaries increased just 0.9% in the second quarter of this year. And that was well below the expectations of 1.2% in the first quarter. So I think that the decrease in wage pressure is really good news for all of us. But like I said, keep your guard up as far as watching what competition's doing.
Right.
So the next thing, let's just touch on national debt. In the spring, I got into this pretty deep. So I'm not going to do that this time. But in the spring, like I said, we discussed the finances of the U.S. federal government. And what's interesting is the first 8 months of fiscal year 2024, the federal budget deficit totaled 1.2 trillion. So that was up 38 billion from the same period a year ago. So for this fiscal year, the deficit's expected to total 1.6 trillion, or about 6% of gross domestic product. So in terms of outlays, factor that I'm watching are net outlays on interest of public debt. So interest payments have soared 185 billion in the first 8 months of fiscal year 23 due to raising debt levels and higher interest rates. So the better news is the federal government's gross debt as a percentage of GDP remains about 100%, which is very manageable given that we have a very dynamic economy that's very innovative and diverse. So in general, America's deficits and debts, in addition to other financial metrics, I think remain amenable to sustain U.S. economic growth and the dollar maintaining its world reserve currency. So when you look at the chart, and you see the 2020 level at 98.2, and so we are at this point at 100% of GDP. And you can see in the past, World War II was when we achieved 103.9%. It is possible to look at reversing this trend, but I think it's going to be really, really difficult for the politicians to really do something with that, considering the fact that, you look at Medicare, Medicaid, the Social Security are the top 3 that are mandated expenditures. National debt is now number 4, and then defense is number 5. And so when you look at the overall debt picture, and you see that, we're around 83 to 84% of our entire budget is mandated by those 5. So tackling, trying to reduce the deficit is going to be pretty ominous task, because if we're dealing with 16% of the budget that we can actually really mess with without it having to move all the way through Congress and the president and trying to change what we're doing as far as the mandated types of programs that we have in place. So I think it's going to be a real challenge for them. And then my personal opinion, one man's opinion, is that we're really going to have to look at continuing to inflate the economy so they have the ability to pay back the debt in cheaper dollars. Either that, or you can ask me about it later or get a hold of me by email. But I think that the other thing that you should look up is the potential for a value-added tax, because it's more benign than trying to raise income taxes. And it's when you're looking for the voting public, nobody wants an increase in taxes. So it'll be interesting to see how they manipulate that going forward.
What is a value-added tax? I don't even know what that is.
So value-added tax goes through the process. So think about this for a minute. If I'm a cotton grower, and I look at selling cotton to a thread manufacturer, through that process, it's taxed. So then I'm a thread manufacturer, and then I sell thread to a jean cloth manufacturer. So then when it goes from that stage to the next, it's taxed. Then the jean cloth manufacturer sells it to a jean manufacturer to make jeans, and then it's taxed. And so then the jean manufacturer sells it to a wholesaler, and then it's taxed. And then the wholesaler sells it to a retailer, and it's taxed. So it's not taxed at the very end like we are accustomed to with sales tax, but it's taxed along the way as it adds value to the product.
Okay.
So it's another way it causes inflation to occur as a result of that. But at the end of the day, it's another way to be able to, for the federal government to be able to look at getting additional dollars without having to tax at a income level. So
The price goes up either way.
it does go up.
Okay.
Yep.
Cool. Thank you.
You're welcome. So next slide, this is something that I think is kind of interesting. And when I look at a lot of you that I work with, and I look at demographics, when you look at fiscal dominance, does the federal government, when it does Fed hikes, is it inflationary to the economy or is it deflationary? So you think about it, hikes are deflationary because they make capital more expensive. Consumers will borrow less on homes and autos and credit cards, and companies will borrow less to expand operations. But I gave this some thought the other day and was reading another article. Hikes can also be inflationary in some ways. And especially when the federal government's public debt is very high, even small increases in interest rates can dramatically raise what the government pays out to the public. So if I'm a bondholder, I'm making more money on buying a government bond now than I did 3 years ago because interest rates were much lower. Plus the fact that now more folks will buy bonds because of the fact that the interest rate is higher. So at the end of the day, I think everybody appreciates the deflationary credit channel, but today household debts are largely fixed. 92% of mortgages have a 3.7% average rate, and corporate balance sheets are pretty light. So fewer have focused on the inflationary effects of higher income to bondholders. So no other Fed hike cycle in history occurred while the government debt was so large. So the Treasury is set to pay out $900 billion in interest on its debt in 2024. So that's nearly triple that it paid out at $333 billion in 2021. So those interest payments flow to holders of Treasury securities, and so that's where you can see the spike coming up on that gold line as to how much debt they're actually paying out in interest. And so that some portion of that payment is going to get spent, right? So debt to GDP ratios could average 110% over the next decade, and the Fed's terminal policy rate's expected to drop below 3.5%. So unless and until tighter credit conditions gain traction on the deflationary side, it sounds like a recipe for higher prices in some way, shape, or form. Better news to start thinking about for all of you is thinking about, okay, so who's going to be my target demographic? And if folks are really good at managing their money, then they're going to be willing to spend it because they're probably seeing a higher return on investment and they're going to have more money to spend as a result of the fact that they're getting paid more for safe securities. So it'd be interesting to see. We've talked about this a bit, and I think a couple of the guys have started to look this up as to whether we could come up with mailing lists for FICO scores, because people who manage their money extremely well have money to spend. And so that may be another thing to consider from a targeting aspect of looking at conquesting new customers, that may be a demographic to consider. Okay. The other thing that's kind of interesting is I think the deficits will be large no matter who's going to be in the White House. So official CBO deficit projections for 2024 have grown $400 billion since February, and deficits are expected to hover between 6 to 7% of GDP through 2034. So nothing in the Congressional Budget Office is leading them to believe that we are going to slow down on our federal spending no matter what. So another note, the CBO's latest projection shows that net interest costs overtaking the primary deficit by 2025 on a yearly basis. So these numbers are going to keep getting bigger and bigger and bigger. So most of the US budget is on the glide path higher with little political appetite to rein in unproductive spending. So what's interesting that I read this other article is that every dollar that we spend currently um, on our debt or on our budget creates just 58% of GDP, 58 cents worth of GDP, compared to the 1950s and 60s when investment in defense, energy, and productive tech generated $8 to $10 in GDP. So if you look at the chart, it's kind of interesting. Here we were in 1964, 65, and we were looking at every dollar that we spend of the federal budget, we would create almost $10 in GDP. So, we were investing in lots of good things like defense and energy, as I talked about, or productive technologies. And
Yeah.
now, because of how we spend, where we're servicing Social Security, Medicare, and especially the national debt, every dollar that we spend is producing 58 cents in GDP. So it's really not very productive spending to try and improve what's going on in the economy. So it's another indicator just to watch. Um, the next thing I want to bring up is, and I like watching these indicators on a consistent basis, and I bring them up a lot of times with guys in the group. But a bit, probably a little bit over 2 years ago, this recession scorecard was flashing nothing but green for the U.S. economy. But starting in the summer of 22, there was these ratings started to deteriorate. So first, the Treasury yield curve, it inverted in July of 22, and it was signaling that credit conditions were tightening and really in a serious way. And every recession in more than 100 years has been preceded by a yield shift such as that. And a couple months later, a second of seven indicators, a conference board leading economic index, changed to a recessionary red and has continued to fall. So this occurred before every onset of a recession since the late 1950s, and really kind of as long as the indicator's been around. So the indicator turned decisively negative in Q3 of 22 and shifting into a recessionary red column. And as the June 2024 report, the index had fallen for 29 of the preceding 30 months, moving deeply into negative territory. So this indicator's never fallen this deeply without a recession occurring. So in the month that followed, three more of a series tracked by the scorecard shifted out of expansionary green zone over to a cautionary yellow. So the third indicator was re-rated to a recessionary column in June. As of Q1, the growth rate of the U.S. nominal GDP had fallen below the Fed funds rate. And so such a crossing point that occurred either before or just after the start of every recession back again to the 1950s. So preliminary Q2 GDP data released late July confirmed that that re-rating was happening at that point in time. And then lastly, as you look at non-financial corporate cash flows, that's an indication of the ability of businesses in aggregate to internally fund any capital spending that they want or need to do. So historically, whenever it's posted a year-over-year negative reading, a decline in corporate capital spending has typically followed. So either indicating a recession's coming or a deepening one is already underway. So again, I'm not seeing it on the horizon, but it's really kind of interesting to see these different indicators that are really flashing red and really causes some confusions for the market as to that's why I think we're tend to be late cycle because I think that there's other indicators that are really flashing more into that recessionary area. But as we saw looking at economic cycles, if the Fed can level out what happens on the recessionary side, we may not even feel it. So let's talk a bit about the inverted yield curve. So this is one of Wall Street's favorite recession signals. And like I said, it started flashing red in 22 and it hasn't stopped. So the 10-year yield note has been lower than most of its shorter dated counterparts since that time. So conventional thinking holds that a downturn is supposed to occur within a year and at most really 2 years. So of an inverted yield curve, but that hasn't happened. So the situation has really many on Wall Street scratching their heads about why the inverted yield curve, which is both a signal in some respects, a cause of recessions, has been really wrong this time and why it hasn't worked at this point. So I think what's occurred is that the Fed was behind the curve in slowing inflation. Many companies in the public loaded up on cheap debt before interest rate hikes, and I think that's providing a buffer. I mean, Many of you that I've talked to, tapped equity in your homes. You went after EDI money, EDIL money. I went after cheap 2.65% money that I've got, making a heck of a lot more than 2.65%. So I think that, as companies need to start rolling over debt, this could be a self-fulfilling prophecy for the yield curve. So it could be a case where the yield curve has been lying to us, but now it could be telling the truth that the Fed doesn't act sooner in lowering rates. So we'll see what's going to happen here the balance of the year. Um, the next thing that I want to do is I want to move into the housing market for a moment. And I'm hopeful that those of you that are viewing this on the computer can see this, because I had it on a bigger screen when we were doing the presentations at our meetings. But in more than 200 cities, buyers are going to find a price tag of $1 million or more on the typical starter home. So a housing shortage that worsened over the pandemic has drove the cost of homes to really new highs at this point. So the typical starter home, defined for this analysis to be among those of the lowest third of home values in a given region, is worth at least $1 million now in 237 cities. That's the most ever. 5 years ago, there were only 84 cities. So a typical starter home now is worth $196,611, which is comfortably affordable for a median income household. However, starter home values have grown 54.1% over the past 5 years. So even more than the 49.1% increase in the typical US home in the same time frame. So starter home values have really increased dramatically more. And I think this is really delayed first-time home purchases for many, because if you look at the median age of a first-time home buyer, that was 35 last year, and it was a year older than in 2019. So why do I bring this up? Because a lot of you are looking at the fact, as you work on your conquest marketing campaigns, you're pretty much targeting millennials, boomers, old guys like me. We've pretty much established households. We know where we're going to have our auto repair. You're probably going to go after some Gen Xers. You're going after some that are maybe moving, but your biggest demographic really are millennials, and they are continuing to form households at a more rapid rate than any other generation at the moment, right? So that being the case, thinking about what their challenges of buying homes as they're coming into the marketplace, that is also going to affect looking at potentially what they're going to be doing as far as their transportation is concerned. If they're looking at trying to get their first home, they're probably not going to be out leveraging and buying a new vehicle. So I think that, again, getting your advisors really tuned into your new customers who are a millennial generation, and thinking about the fact of what they're having to do for their household budgets, and really start setting up plans for maintenance and repairs on the transportation that they're going to need. But it's really kind of fun, kind of interesting to look at some of these cities like San Jose. It takes 464,000 average household income to deal with a cost of a home that's median price 1.8 million. And you look at the different markets around the country, Phoenix in my area is 114,000, but you could certainly go to Cleveland, Ohio, and see it at 58.4 thousand. So again, just looking around certain areas of the country, and many of you realize, depending on where you're at today, how much of an increase you've seen in housing costs. And I think this is we've got to be really cognizant of this when we're dealing with our potential millennial new buyers for our shops. Next thing that I think is there's some good news on ahead, looking at what's happening for home buyers that I think we should be aware of, is that after years of heightened competition and slightly more balanced market, maybe just on the horizon, there are more homes on the market as the effects of rate locks ease and builders continue adding more supply. So with more homes for sale, buyers have more time to weigh their options. And so rising housing inventory is also helping the negotiating power swing in buyers' favor, as opposed to and price cuts also are at record highs for this time of year. So that we may see some easing, which will be good. So I want to shift gears a little bit, and I think this is some pretty interesting data that I want to spend some time on, that I think is going to have some longer term effects. And I know that I've got certainly a lot of younger guys that are in the group that I really want them to pay attention to certain demographic changes that are going to occur. So the next topic I want to address, I believe, will have some mixed consequences in our economy in the coming years. So that is America's declining fertility rate. So because the growth rate of any economy is dependent on population growth, the larger the population, the greater the labor force, the more capacity for consumption as workers per capita incomes increase, and the deeper the base of labor to support retirees. And that's where a lot of the CBO goes through these projections, because they're thinking about who's going to be behind me, especially as I get into Social Security years, are going to be around in order to pay that toll. So throughout history, a nation's population has always been a marker of strength or weakness based on its population growth. So what's interesting is the number of babies born in America in 2023 clocked in at a record low of 3.6 million, and that was down 2% from a prior year. So meanwhile, US fertility rate was 1.62 last year, well below the 2.1 ratio needed to maintain a stable population. So the latter figure is down from 5 births per woman in 1950, and reflects a number of socioeconomic factors ranging from, rising female education levels, prohibitive costs associated with child rearing, easily available contraception, and more female employment and career opportunities. So women in the US now are better educated, better paid, better positioned to advance in their careers, and as a consequence are having fewer children. So whereas the average size of a family hovered around 3.7 in the 1960s, today it's smaller to about 3.14 in 2023, according to the Census Bureau. So you can see, looking at the chart, this is again from the Congressional Budget Office, population growth generally slows over the next 30 years from 0.6% per year on average between 2024 and 2034. And then from there, it drops to 0.2% per year on average between 2045 and 2054. So net immigration increasingly drives population growth, and it accounts for all the population growth beginning in 2040. So in part because fertility rates remain below the rate that would be required for a generation to replace itself in the absence of immigration. So this is the other thing that I think is going to be extremely important. And those of you that are diligent in voting, I think we need to really influence our politicians in looking at making adjustments to our immigration policy and do a better job of being able to bring in talent into our country. I'm personally looking into the TN NAFTA agreement. Jerry Vicario, many of you who know him in the group, he and I are doing a little bit of homework to see if there are possibilities to bring in engineers from Mexico. So if there is part of the NAFTA agreement that does allow for that possibility to occur. So we're doing some homework, and we'll see if that might be a possibility. But the main reason the CBO creates the projections, again, is because to measure Social Security population and estimate the taxes that are brought in and benefits that are paid out. Another factor, but less known, but I think just as important and overwhelmingly positive, helps explain the declines in America's fertility rates. The drop also stems from a sharp decline in teenage birth rates, so which have fallen precipitously over the decades. So in 1970, for instance, women between the ages of 15 and 19 accounted for 17.3% of all the newborns in the US. And teen birth rates totaled 645,000 in 2023. However, the number of births from teens tallied in now, it was then teen birth rates were 645. Now they've tallied in 141,000. So a big drop. And teen births accounted for only 3.9% of the total births in the US in 23. So again, it's sharply down from where we were several decades ago. But there are a lot of positive benefits to the economy. In an economy where young women, notably teens, are better educated, they're in better health, they're in better shape to advance their personal and professional goals before having children, a lot of good things happen. So economic growth accelerates, income inequalities narrow, and the labor force expands, and children grow up healthier. So why do I bring this up? As opportunities afforded to companies in terms of supply, female workers, demand, female consumers, and earnings expand significantly. So the decline in teen birth rates is just one more marker supportive of women being an economic force unto themselves. But let me tell you some other signs, and then I want to make some emphasis at the end of this. So after a
Okay.
decade of little progress, Americans' gender pay gap has narrowed by over 2% since 2019. So women now make 84 cents on the dollar. Now, I hear from some of you, obviously that's not parity for sure. Women earned just 62 cents on the dollar in 1979. And that was according to the Bureau of Labor Statistics. So a marked improvement. So women continue to graduate with post-secondary degrees at higher rates than men. So according to the latest data from NCES, women account for 59% of the bachelor degrees and 57% of the doctoral degrees that are earned, while the percentage of master degrees is even higher at 63% of the total compared to men. So the number of prime age women, 25 to 54, in the labor force is at record highs. So after falling precipitously during the pandemic, labor force participation of prime age women hit a record high of 78.1% of May of this year and remains at a lofty 77.9% in June, according to the Bureau of Labor Statistics. So women have also made notable progress in establishing financial independence. So to this point, single women who live alone are more likely than single men counterparts to own homes in a vast majority of the US states, 47 out of 50. So single women own 11 million homes in the US versus 8 million for single men, according to the Census Bureau. So the number of women-owned businesses increased at almost double the rate of businesses owned by men between 2019 and 2023. So presently, some 14 million businesses are owned by women, nearly 40% of the US total. And that's up 14% from 2019. And then finally, if you look at some other statistics, the wealth of women is set to explode. So already women control about 1/3 of household financial assets today, or about $10 trillion. With the coming great wealth transfer ahead, women in the US are projected to control much of the 30 trillion in financial assets that baby boomers now possess by 2030. And that was through McKinsey estimates. So for those of you that are planning to be in business for quite some time to come, this is really going to be important to pay attention for future employees and future customers. And I believe that we need to do a better job as an industry in all of our stores and looking at importing talent, but also looking at what we're doing for female customers. And at the end of the day, think about how your messaging is going out in your direct mail. How is your website language attracting females? What is it that you're doing differently in your write-up areas? How does it look? How does it smell? How are your people interacting with female customers? And what are you going to do to attract a larger portion of that demographic? Because economically, that force is going to get stronger and stronger and stronger as we continue to keep moving over the years. So I can't emphasize enough all the things that I think are going to be really important for you to consider. Okay, Darrin, I wanted to take just a break because I want to jump in to start talking about our industry a bit and get away from
Of
the
course.
30,000 foot view of what's going on in the economy. So are there some questions that we should answer in the interim?
Yep, let's look and see. Hannah, do we have any other questions? I don't see anything in the panel here. There's some comments that you put in here. Thanks for doing that. But I don't see any other questions. Anybody have any questions for Jim at this point? Okay. I don't see anything in here. So if you guys have any other questions for
Okay.
Jim, please feel free to put them in the chat. We can definitely answer them for you here.
Okay, cool.
Yeah,
All right.
cool. I know you got lots to cover, Jim, so thank you.
Yeah, no worries. I just
Okay.
thought I would see what was happening with all that.
Yep, it's
So,
great.
yeah.
Okay.
Okay. So let's jump into our industry. So I think it's important to continue to look at what's on the horizon and of what's happening with vehicle manufacturers to kind of anticipate what's going to be at our front door in the near future. So in the next slide, I want to play a video from one of my favorite research analysts in the car industry. His name is John Murphy. No relation. So I really learn a great deal from his weekly insights along with some of his more in-depth reports. So he released one mid-year about what he feels will occur during 2025 through 2028. And some of the key metrics that I want you all to be aware of is that, first of all, when we look at replacement rate, that's the estimated percentage of OEM sales volume to be replaced with all new models, given the definition that you see on the screen. Next will be average showroom age, so the number of years on the market for the average model of an OEM showroom. And then new model volume mix, so the mix of new models by segment during that forecast period. So sit back for a minute, listen to this. I think you'll find his comments pretty interesting, especially at the beginning of the presentation. It's not very long. And then there's a couple conclusions that I want to talk about after his review of that. So
Great.
let me play this.
Hello, I'm your host, John Murphy, BofA Global Research's U.S. Auto Analyst. I wanted to intro our latest product pipeline analysis, Car Wars 2025 to 2028. If you can't find them, then grind them, as well as 10 key findings from the analysis. Car Wars is our proprietary study assessing the relative strength of automakers' product pipelines in the U.S., first published in 1991. The purpose is to quantify industry product trends and relate our findings to investment decisions. This year, we dug deeper into powertrain strategy and found that the unprecedented EV head fake has wreaked havoc on product planning. This is most obvious in the number of forecasted EV launches dropping from 148 in last year's study to just 113 in this year's study, while at the same time, the count of ICE and hybrids remained relatively steady at 112 and 156 respectively. This U-turn appears to favor extended ICE programs, but the recent hybrid hype is not driving much real action. The next 4 years plus will likely be some of the most uncertain and volatile in product strategy ever. In our view, it is extremely important that automakers leverage core ICE portfolios to generate profit, cash flow, and capital to fund the uncertain EV future. Now on to 10 key findings for the industry and specific companies. First, total product activity is just okay, with most major OEMs struggling with the powertrain conundrum. The range of strategies remains wide, with some OEMs focusing on high-volume ICE models, while others lean into lower-volume EVs. Second, replacement rates are just below the historical average of 15% in model years 2025 and 2026, but accelerate in model years 27 and 28 with more models, including a few that are very high volume. Third, new model mix is overweight crossover utilities and slightly underweight all other segments. This should be somewhat supportive of mix going forward. Fourth, volatility is increasing as OEMs struggle with long-term product commitments based on powertrain configurations. Delays and cancellations of product launches are increasing. Fifth, in terms of traditional replacement rates, BMW, Tesla, VW, Ford, and Honda appear to be best positioned, while GM and Nissan are the worst. Six, the Detroit Three have a relative spread of replacement rates. Ford the best, Stellantis just below average, and GM the lowest. GM's steadfast commitment to EV launches is weighing it down for now. Ford and Stellantis' broader powertrain strategies appear better positioned for the next 4 years. This is all still evolving, so stay tuned. Seventh, Japanese OEMs have an uncharacteristically volatile product cadence with a differentiated segment focus on cars. Replacement rates are spread around the average, with Honda above and Toyota and Nissan just below the average. Eighth, Hyundai and Kia's cumulative replacement rate is just below average, but accelerates meaningfully in model year 27 and beyond. The duo's launch mix is overweight CUVs and small cars. Ninth, European OEMs replacement rates are well above average, with BMW and VW relatively high and Mercedes low. Launches are dominated by crossovers and luxury and sporty cars, as well as alternative powertrains. 10th, Tesla is at the high end of the replacement rate range, as are other OEMs. These are mostly smaller OEMs, as well as new EV entrants. Launch mix for Tesla and smaller OEMs is skewed to crossover utilities and overweight EVs. Thanks for diving into Car Wars with us. If you'd like to catch up on this or anything else, or have any questions, you know where to find us.
Okay, so let's talk about a couple things that he brought up. So when you look at total product activity, the pedestrian pace of new product launches from model year 25 and 23, 26 have some acceleration, but then they dip again in 27, 28. And that it's indicative of what's happening with the manufacturers because they are struggling with powertrain strategies more than anything else. And I think this is really becoming very apparent with the big three manufacturers. But also looking at what happened this week, Volkswagen just announced that it's going to close 3 plants in Germany. Their costs are high, but they're also struggling with the powertrain conundrum. As you look at the replacement rates that are just below the historical level of 15% for model year 25, 26, but accelerate again in 2027 and 28. So this is a result of numerous EV launch delays near term, as well as the launch of a lot of high volume programs in 27 and 28. One thing I want to mention as well, for those of you that may or may not have caught this, but Stellantis announced that its sales are free falling. Their sales between July and September fell 19.8% from the year before, and Chrysler and Dodge plunged more than 40.3% in the third quarter. So all their lines except Fiat logged negative growth. So you can see where overall the manufacturers are really struggling to try and figure out their positioning and where they're going to go from here. So, but you'll see, you can see where model launches on this chart for 27 and 28 do accelerate going forward. The next thing was looking at it as manufacturers struggle with product mix. One of the key areas is the future penetration of EVs. And so what I want to do is dive into some of the data. What was interesting to look at some of the stats on vehicle penetration around the market in the United States. Those in the darker areas, that's 30% of market penetration for EV sales, and you can see much of that happens on the West Coast, a little bit in the central area around Colorado. But again, from a strategy standpoint, and this is what I think is most important to keep thinking about, is that where are you going to make your investments going forward as far as training with your technicians or potential equipment that you're going to look at being involved with EVs. And so I can see where much of the country, it's not going to make sense quite yet to make those types of capital expenditures, but there are areas of the country where it will start to make more sense. But let's talk a little bit about why. So when you look at as the hype of EV grows, the penetration forecast for electric powertrain, especially on Murphy's estimates, are kind of interesting. So the analysis starts with the assumption that the most important factor that will drive EV penetration are the upfront personal purchase costs of the vehicles for consumers. So that's really what's swaying the adoption rate, is how much is it going to cost me to buy an ICE vehicle compared to an EV vehicle. So I believe that a better product at a better price will win, and it usually does. So therefore, the comparison between a component and input cost for automakers is crucial as to how automakers will set prices for their vehicles. So the metrics reviewed are looking at the cost component per vehicle and the subsequent average transaction price, and then the total cost of ownership. And the total cost of ownership obviously matters over time, but there's really low levels of consumer experience. What does it really cost me to operate an EV over the time period that I own it? And it's still early in the game. So I think that this will have more meaning as time goes on. But when we look at the first step of an ICE versus an EV analysis, it begins with the component costs of the two. So the underlying approach assumes that the cost of an EV wholesale parts declines and eventually reaches cost parity with ICEs, and OEMs would ultimately be able to work EV prices down to competitive level. So this chart shows that the component cost for EVs is $34,724, and it compares with the total component cost of ICE vehicles at $24,885. And powertrain making up 47% of the EV costs and 40% is the powertrain for ICE. So looking at all of those when we talk about component costs for the ICE, or we're talking about basically the engine, transmission, the exhaust, the fuel system, the axles, the drive shafts, and the climate control systems and engine cooling. And for EV, it's because it's simpler. We're talking about the electric motor, the transmission, the power electronics, the architectural, electrical architecture, and then obviously the battery. And it puts it at a much higher price tag. But if you look at the next, if you start to really break it down, it's kind of interesting. So the estimate total direct ICE powertrain content was 10,050 in 2023 versus the total direct EV power content at 16,280. So for ICE, the component is the largest part of the powertrain cost is the engine, which is 45% of the total powertrain cost, right? So, but if you look at EVs, the battery instead is by far the costliest component of the EV powertrain, and it represents 75% of the total powertrain cost. So you can see for obvious reasons why manufacturers are hard charging to look at improving battery technology, going to solid state batteries, things of that nature, and trying to get weight out of the battery component as well. Because this will also help to try and improve the cost factor and work towards getting to that parity that they are furiously trying to get to in order to improve EV adoption. When you look at total cost parity between ICE and EV, that's expected to happen around 2029. So when you look at Murphy's forecast, it's driven primarily by a steep decline in EV costs. And on the other hand, the forecast is for ICE components to gradually climb just from inflationary pressures. So due to stricter environmental regulations as well, and just to diminish economies of scale. So 2029 is where a lot of the money is chasing, looking at parity at this point between ICE and EV, and that's looking at the initial price of that vehicle. When you look at U.S. volume penetration, further analysis shows that by 2024, 43% of the vehicle market is priced above the average EV price, and by 2030, 52% will be priced above it. So based on this short term, OEMs have a few economic incentives to ramp up EV production despite a potential demand driven by par prices. So it's estimated that EV penetration will inch in 2024 at 8%, to 2027 about 14% without any major breakthroughs. So however, after 2027, it's possible to see that EV penetration will accelerate with an end projection in 2030 at about 29 to 30% of the market. So again, we're talking about total US penetration. So the overall marketplace, there are going to be areas where penetration might be better in certain areas on the West Coast. But obviously in flyover country, in the central part of the United States, this isn't going to be necessarily the case. And so again, from a planning standpoint, for all of you that own shops, this is what's important to me to pay attention to, is that best case scenario on overall US penetration, the money is predicting that it's going to be 29 to 30% penetration by 2030. So still not overwhelming numbers at this point as far as the number of units are concerned.
Still nothing like some people have estimated, including some of the new Chevy,
right.
It's pretty amazing.
Yeah, exactly. So anyway, the other thing that I found interesting along the study was the last step of ICE versus EV and the cost parity analysis focus on total cost of ownership. And again, this is more of a situation where it's kind of forecasting as opposed to what is actually occurring. All of us know that, the upfront costs are what's going to persuade customers the most. But I think total ownership costs between ICE and EVs are going to grow important as customers' expectations for ownership costs of EV become much more clear. So for the consumer, depreciation of the vehicle is the single biggest component of the ownership cost. So we discuss this a lot in the group to make sure that customers are aware that, especially when making a large repair decision, as opposed to looking at buying a brand new vehicle, many times they're not factoring in depreciation as then that largest cost of ownership. So So when they're purchasing a new vehicle, many don't hold it till the end of its lifetime. So the calculations here show depreciation rate over a 4-year period. So typically, consumer purchasing a new vehicle will usually trades it in 4 to 5 years later for another one. So on average, the assumption is that the consumer receives 40% or less of that value from the initial price of the residual value. So you can see, looking at some of the stats for this, like for ICE, repair and maintenance costs over a 4-year period are remaining about 9% of the original average transaction price from 24 to 2030. And EV looking at about 7% of the original transaction price for 24 to 2030. And that's with obviously a much larger price of the vehicle over than for the initial purchase. What's also interesting looking at some of this is that for total cost of ownership of ICE versus EV, that parity price may already be coming right around the corner. So, the chart illustrates, looking at this, if we're bringing in total cost of ownership as well as the initial cost, it's expected that EV and ICE to really reach a parity maybe as soon as 2025. So we'll have to see how consumer behavior will react as to, is it going to be a situation where it's going to be initial cost will have more of an influence going forward, which means then parity is going to be delayed until 2030. Or 2029, 2030, or is it going to be a situation where they will become better informed and start to say, it starts to make more sense for me to own an EV because cost parity will be fairly similar probably by the end of next year. So something to consider and to watch
Okay.
as we look at sales going forward. The next thing I wanted to jump into was looking at what Ford's been doing lately. So the Ford program in the automotive industry has really become a multi-billion-dollar battleground for U.S. automakers, and it's really led by Ford at this point. So many fleet sales, especially daily rentals, have historically been viewed as a negative for auto companies. So they've traditionally been less profitable than sales to retail customers, and are used a lot of times by the automakers as a dumping ground to unload excess vehicle inventories and really boost sales. Fleet sales typically account for 18 to 20% of the annual industry U.S. light-duty vehicle sales, and according to J.D. Power. What I found interesting about the research on this is that part of the opportunity in fleet sales comes from the aging vehicles in the U.S. roadways as far as sales are concerned. But here's what I think is an opportunity for a lot of you that are looking for areas to continue to grow your business. So the average age of 25 million fleet and customer and commercial vehicles on America's roads was guess. So Darrin, do you remember the number as to the average age of the 25 million fleet and commercial vehicles on American roads?
I think it was 12 or 13 years, wasn't it?
No, so that was the average age. 12.6 years is the average consumer vehicle on the road in 2023. But the average age of a fleet vehicle on the road right now is 17 and a half years old.
Wow.
So to me, commercial sales are they're viewed as a good area for manufacturers to look at trying to do a better job in the way that they're penetrating that market. But
Yeah.
for those of you in the group and those of you that are listening, when you think about the opportunity that your average fleet vehicle is at 17 and a half years, and you consider how many miles are being put on those vehicles, I still think that that's a great opportunity to consider pursuing fleets in your mix of work. A side note, it was interesting also, Ford announced August 21st that it's delaying production of its new plant in Tennessee to produce a next generation all-electric pickup. It's also canceling plans for its 3-row electric SUV, and Ford said it's going to prioritize hybrids going forward. Earnings came in yesterday for Ford, so they announced third quarter earnings, and again announced that they are going to be pivoting away from EVs. Their earnings were pretty dismal, so it's going to be interesting to see again what the domestics do from their EV strategy, but it's extremely disruptive at this point. So let's shift gears just slightly. When I was doing some homework, looking at some of what the tire industry is doing, Ford Forbes has featured Enzo's innovation. So they're highlighting a more efficient, less polluting tire that's going to be essential for EVs. Tire pollution is something we talked about in the spring rounds of meetings. We're exposed to more parts per million because of dust from tires than we are from tailpipes. No tire lasts forever. Every time a tire accelerates or brakes or turns, it wears down, emitting thousands of tiny particles into the air. And globally, tires emit 6 million tons of pollution each year, and tire dust represents 28% of primary microplastics floating in the ocean. So what's interesting, looking at Enzo tires, the CEO talked about some details about 10% lower rolling resistance than regular tires. It'll make the EV cheaper to run. 35% increase in tire life means lower wear, fewer particulates in the air, and fewer old tires sent to the incinerators. And Enzo is also looking at handling the recycling of it. So it'll truly be a carbon neutral, not reliant on carbon offsets. And the manufacturer of tires out of resale, their plan is to make it out of recycled carbon black and tire silicate made from rice husks. So they're aiming for production of 5 million tires from a new factory by 2027. The location is being finalized now. It's either going to be in Colorado, Nevada, Texas, or Georgia, the likely locations. The interesting thing is I'm going to play a video for you, and I want you to listen to the content of the video. I think it's going to be interesting looking how they're proposing for this particular business model to take hold. So let me go ahead and play this for you.
Awesome.
We all want to breathe clean air, and we all want clean oceans, but it's complicated. With the scale of pollution and climate change, it's easy to feel we have no control. I'm here to tell you that you can make an impact by helping us tackle a major source of pollution in our air and oceans: tires. I'm Gunnlaugur Erlendsson, founder and CEO of Enzo. Our mission is to massively reduce air pollution in our cities, microplastic pollution in our oceans, and help stop climate change with better tires for electric vehicles. When I started in the automotive industry over a decade ago, what surprised me the most was the impact of the tires we use. Tires are the next big environmental scandal that nobody is talking about. Tires are largely made from fossil fuels, which constantly wear down. And as this happens, they emit billions of particles. The effect of these particles is huge. More particulate air pollution that we breathe every day comes from tires than all tailpipes combined. These particles don't break down. They stay in the environment, with many ending up in our oceans, where they are responsible for over a quarter of all primary microplastic pollution. Then, at the end of their short life, most tires are incinerated, collectively emitting billions of tons of CO2, accelerating climate change. But perhaps the most surprising thing about tire pollution is that most electric vehicles emit even more of it. Because of their large batteries, electric vehicles are heavier, and electric motors exert more torque compared with vehicles with internal combustion engines. It's simple physics. More weight, more torque means more friction and more tire pollution. So while electric vehicles are our future, unless we solve the problem of tire pollution, it'll go from bad to worse.
This is why Enzo is developing more energy efficient, sustainable and durable tires for electric vehicles. Bio-based, low-carbon raw materials with advanced chemistry and engineering techniques. Enzo tires have been designed to be more durable, so they emit less tire pollution in our air and oceans. They are also designed to be more efficient, using less energy and therefore emitting less carbon. Our tires were recently awarded A energy efficiency ratings in Germany, extending electric vehicle range compared with other market-leading energy-efficient tires.
Enzo will operate a completely new and unique service with a direct-to-customer pay-per-mile model. This allows us to bypass legacy distribution to serve EV car makers, fleets, and individuals directly at a competitive price. Importantly, charging our customers per mile based on the distance they drive, rather than the tyres themselves, shifts incentives away from cheap, short life tyres towards longer life, lower polluting tyres.
We're proud to announce we have recently secured funding from the UK Future Fund, ahead of our commercial rollout this year in the United Kingdom, Europe, and North America. It is said that a good traveler leaves no tracks, and Enzo can help make us all good travelers, reducing tire pollution and waste, so we can all live and breathe a little easier.
So hopefully a lot of you caught a lot of that in regards to the fact that they're looking at a pay-per-mile plan along with direct to consumer. So it'll be interesting to see how successful they are in looking at influencing the industry going forward. But that was just another area from a planning standpoint that I think will be important for all of us to keep ourselves aware of, as many of you are moving into the tire business, especially within the group. They are looking to do that. So I think it's going to be some pretty interesting trends upcoming over the next 5 to 10 years. So we've covered a lot today. I hope that all of you that attended will have some good takeaways. I think it's important to spend some time with your staff, especially talking about the future. And I really want to challenge all of you to take the time to have some productive meetings with your staff. I mean, I brought up a lot of interesting demographic shifts and industrial shifts that I think are going to be happening pretty much over the medium term. So I really want to challenge you to have those conversations with your staff. So Darrin, this concludes my presentation. And if we have any questions, please let me know.
Yep. There's a couple in here that I thought was interesting. Give me a second to get it pulled up here. But it was like, what is a good area to focus on, for future growth of businesses? Do you have any insight on that, Jim?
Well, obviously, we brought up about looking at women, right? And so women demographic, to be able to capture more of that market, I think is going to be extremely important. So it's such a broad-based question to say, what should I focus on? I think it depends on what some of the objectives are. If you're going to look at competing in certain marketplaces, I think having some focus on the tire business and looking at folding that more into some of the growth strategies, I think is going to be important. If we're going to capture more and more EVs over time, and we're going to look to try and get the frequency rate of those vehicles coming into our stores, I think tire rotation will be one of the things that will be a key to looking at getting them to be in your stores, as opposed to hinging it on oil change frequency. So I think that's the other part that I think is pretty important. So, but I don't see ICE vehicles going away very quickly within your doors. And I think that continue to keep focused on that, and looking on the horizon and having some initial investment in the EV space with your with your technicians, I think will be important. But again, it's going to vary market to market as to what to focus on specifically.
Yeah, no, that's great. Thank you for that, Jim. And it's let's see, there's another question about is this being recorded? And yes, it will be recorded, and we will send it to everybody afterwards. It takes a little bit of time for it to download, but yes, we will send it out. Other than that, I don't really see any other questions here that are just other comments that's supporting, but saying thank you. Thanks, Gerald, for your feedback there too. But yeah, I think that's probably pretty good, Jim.
Okay, cool. Well, thank you everybody for spending time with me today. I sure appreciate it.
Yeah. I'm grateful, Jim, for you taking your time out and being with us. Do you have a couple more slides here?
I do.
Perfect.
Let me advance that forward. Here we go.
So just wanted to take this minute to remind everybody to come to the Ignite that we've got coming up January 24th to the 25th. So if you haven't signed up yet, scan this QR code and we'll get you into the funnel and get you guys signed up. We'd love to have you come. We got a lot of good content planned, and the schedule is now out, so you can go look and see who we've got coming. We've got a bunch of good keynote speakers and Six Sigma people coming, and a lot of good training coming up for this. So excited for that. So come and check that out. And then see here. Yeah, there's also a link. Thanks, Hannah, for putting that in the chat too. You can click the link and it'll get you signed up as well. And then if anybody here that's not a member of Elite in the Pro Service or Top Shop client, feel free to scan this QR code and we get you a free strategy sessions scheduled with either Matt Lofton or Joe Marconi or Tom Amero, and get you some more information on what we do and how we can help your business. So we do coaching and consulting, and like Jim just talked about, our peer group is wonderful. We have some awesome shop owners in there and a lot of great operators. So we'd love to help you any way that we can. But thanks, Jim, for being here.
Yeah, my pleasure. Super fun as always.
Yeah, I appreciate you. And thanks everybody else for being here and attending. We do appreciate your spending time with us today. So.
Okay. Well, thanks so
All
much,
right.
Darrin.
Okay. Thank you. Take care, buddy.
Okay. All right. Bye-bye.